Howdy, folks. Welcome back. It's Liberty Call for Thursday, March 17th, 2022. It is St. Patrick's Day. Got my green on. Doesn't look very green on the screen, but it is green, I do promise. And you see Barney over my shoulder here. He's taking a nap, and his tummy's growling. So if you hear some groaning and creaking, it's his belly. So he normally doesn't eat breakfast. So he's a one meal a day old fart dog. So anyway, so like I said, it's St. Patrick's Day. Pinch some people on the booty, unless you're butterscotch. He got in trouble last night on South Park for being a sex offender for pinching a girl on the butt because she wasn't wearing green, but she did have green socks on, so they put him in jail. Anyways, it is March Madness. It is kicked off. There are games on my screen, which is beautiful. So I'm going to try to keep this short so I can get back to my basketball. Kind of a boring day in the market. Market was up. I guess a lot of people feel pretty good based upon the interest rate slight increase. It's kind of like throwing a thimble of water at a 5-alarm inferno. But hey, if people feel better because the Fed did something, hey, I guess that's a good thing. But anyways. All right. Well, if it's your first time watching, please click on, there's probably a subscribe button right about there. And if you're on YouTube, and give me a thumbs up if you're watching on YouTube. If you're watching on Facebook, please like my page and share it with friends and family. I would greatly appreciate it. I'm sure, there's something I'm going to say today that'd be valuable. I can't promise it. I'm kind of winging this as I go. I have a number of stories and some things I want to talk about, but I don't have a script. As you can tell, there's a lot of ums and ahs and anyways. All right. Well, let's go ahead and see how the markets did today. Dow Jones was up 1.23%, closing at 34,480. S&P 500 up 1.21%, closing at 4410. NASDAQ up 1.33%, closing at 13,614. Small caps are also up almost 2%. The VIX was down another 4% today, closing at 2558. All right, let's look at the other Americas. Canada was up, Brazil was up, Mexico's market was up, getting into Western Europe. Germany was slightly down. The FTSE was up 1.28%, France up 0.36%, the Euro stocks slightly down 0.11%. Netherlands and Spain were both up. Italy down slightly, about 0.66%. All right, lots of green. The only other down I see here is Sweden, down 0.38%. Russian market still closed again today. Getting into Eastern Europe, markets are up 3, 2, 2, 1.5. I mean, looks pretty good across, the Eastern Europe and getting into Western Asia. As we get into the Asian markets, Australia was up 1.05, New Zealand 0.93. The Chinese markets, the Shanghai was up 1.4, the SCSC component up 2.41, the China A50 up 2.27, the DJ Shanghai up 1.54, the Hang Seng up another 7.04%. It was up, I think, almost 9% yesterday, if memory serves. And a couple of down ones, but these are some pretty small markets or exchanges around the world. So all in all, not too bad for trading day, March 17th. Maybe it's the luck of the Irish. I don't know. So there's a bunch of Irish in me, along with Swedish and Dutch and Bohemian and, a lot of Eastern Europe, a lot of Western Europe. Basically, I'm a giant mutt. So, I pretty much have everything in my background from, Western Europe all the way to, Eastern Europe, except for Italian and Spanish. I don't have any of that in my lineage that I've been able to track down. So my son does. My wife is, I guess, an 8th Spanish or something like that. So anyways, all right, well, let's take a look and see. So I have a few articles I want to breeze through here. All right, let's make that a little smaller so you can see my beautiful face. U.S. economy flexes muscle with jobless benefit rolls at 52-year low, and factories are humming. Written by Lucia Mutakani from Reuters. The number of Americans filing new claims for unemployment benefits fell last week as demand for labor remained strong, positioning the economy for another month of solid job gains. Unemployment benefit rolls were the smallest in 52 years in early March. The Labor Department's weekly jobless claim report on Thursday also showed signs of the economy's underlying strength against the backdrop of rising inflation and geopolitical tensions were also evident in other reports showing an acceleration in manufacturing production last month and a sharp rebound in home building. So that's some good news. Initial claims for state unemployment benefits decreased 15,000 to a seasonally adjusted 214,000 for the week ending March 12th. Economists polled by Reuters had forecast 220 applications for last week. A 16,006 drop in claims in New York erased notable increases in Michigan, California, and Ohio. Claims have declined from a record high of 6.149 million in early April of 2020. The three-week-old Russia-Ukraine war poses a risk to the U.S. labor market through disruptions of supply chains and record high gasoline prices. With companies hungry for labor, economists are optimistic the labor market and economy will ride out the storm. There were 11.3 million job openings at the end of January, with a record 1.8 open positions per unemployed person. So almost 2 jobs per person looking for a job. So, jobs are out there, folks. Maybe you just don't have the skills to fit those positions. This misalignment between demand for labor and supply is boosting wage growth, which should provide some cushion to households against soaring gasoline prices. Fed Chair Jerome Powell on Wednesday described the labor market as extremely tight, telling reporters, quote, "We think the labor market can handle, as I mentioned, tighter monetary policy, and the overall economy can as well," end quote. So far, the economy is holding up. A second report from the Philadelphia Fed on Thursday showed factory activity in the Mid-Atlantic region accelerated in March, with manufacturers reporting strong growth in new orders as well as shipments. Factories in the region encompassing eastern Pennsylvania, southern New Jersey, and Delaware hired more workers and increased hours for employees. They, however, continued to struggle with higher output prices and delays getting materials, which kept orders backlogs long. Excuse me. Strong manufacturing was also underscored by a third report from the Fed showing production surged 1.2% in February, despite motor vehicle output shrinking 3.5% because of a continued global shrinkage of electronic components. Last week's claims data covered the period during which the government surveyed business establishments for the non-farm payroll component of March employment report. Claims fell considerably between February and March survey periods, which bodes for job growth this month. The economy created 687,000 jobs in February. Employment growth has been aided by the return of some workers to the labor force amid a significant decline in COVID-19 infections. More could rejoin the workforce this month. The claims report showed the number of people receiving benefits after an initial week of aid dropped 71,000 to 1.419 million during the week that ended March 5th, the lowest since February of 1970. The run of upbeat data was extended by a fourth report from the Commerce Department showing housing starts jumped 6.8% to a seasonally adjusted annual rate of 1.769 million units in February, the highest level since June of 2006. While permits for future home building fell 1.9% to a rate of 1.859 million units, they were not too far from the nearly 16-year high touched in January, suggesting an acute shortage of houses will continue to underpin residential construction even as mortgage rates rise. Single-family housing starts, which account for the biggest share of home building, jumped 5.7% to a rate of 1.215 million units last month. Starts for housing projects with 5 units or more gained 0.8% to a rate of 501,000. The backlog of houses approved for construction that are yet to be started hit a record 271,000 units as builders struggle with shortages and very expensive materials. Quote, "The record high number of units that were authorized but not started, combined with permits data, suggests that housing construction will continue to add to growth in the coming months to the extent that builders can contend with supply constraints," end quote, said Conrad DeCodros, senior economist at Breen Capital. In the wake of data, the Atlanta Fed raised its estimate for the first quarter GDP growth to a 1.3% annualized rate from a 1.2% pace. It has steadily boosted its forecast from a low of 0.5% of contraction at the end of February The economy grew at a robust 7% pace in the fourth quarter. So, some good news. People are getting back to work, even though things are more expensive. It does appear we're still having issues with supply chains around the world, but it's going to get better. It can only get better at this point. I mean, things will get worse in some aspects. I imagine the stock market and things like that are going to go through some turbulence here in the near future. But personally, I think if we keep a positive view on things, I think we'll be all right. Okay, next article: oil back above $100 as war risk pendulum swings. Written by Bharani Krishnan from investing.com. Don't ever count the oil bulls out, not with Vladimir Putin around. Crude futures flew back above $100 a barrel levels on Thursday after a Kremlin spokesman described reports claiming solid progress in Russia-Ukraine talks as, quote, wrong. And Putin himself vowed not to succumb to Western pressure in ceding Moscow's invasion of Ukraine. U.S. crude's WTI benchmark settled up $7.94 or 8.4% at $102.98 a barrel. WTI had lost a total of 13% in three prior days, settling at just above $95 on Wednesday. Brent, the global benchmark for oil, settled up $8.62 today, or 8.8%, at $106.64 a barrel. Brent fell below $98 in the prior session after losing 13% from Monday through Wednesday's slump. Both WTI and Brent both settled below the $100 mark on Wednesday for the first time since February 25th. The three-day sell-off was the largest market drop percentage-wise since the crude price collapsed in April of 2020. That occurred during the height of the demand destruction to oil from the COVID-19 outbreak. Adding to the upward pressure were remarks from the Paris-based International Energy Agency, or IEA, on Wednesday that some 3 million barrels a day of Russian production could be shut in from April due to the difficulty of finding buyers. Western oil majors such as Shell said they won't buy Russian crude anymore, while many more buyers are trying to find alternative sources to avoid the risk of violating U.S. sanctions unintentionally. By contrast, India plans to circumvent Western measures by trading in non-dollar currencies, are still in embryonic stage. So it looks like India is going to kind of circumvent the way the oil is bought. So, hey, I don't blame them. They can get it cheap. That's the way it is. All right. Next article: the Fed is on the verge of repeating history. Morning brief from Jared Blickery. All right, let's dive into this. The Federal Reserve finally took the plunge and raised interest rates. Woo! I mean, isn't that just crazy? Going up a quarter of a point or 1/4%. As expected, Fed Chair Jerome Powell led the FOMC to raise its benchmark interest rate target to 1/4%. The Fed famously operates according to two mandates: price stability and maximum employment. How the Fed achieves these goals is up to Powell and co. But if past is a prologue, there could be trouble brewing as the Fed amps up its hawkishness. In the modern era, the Fed has developed a bewildering array of tools: interest rate targeting, forward guidance, interest on excess reserves, repo facilities, quantitative easing, and quantitative tightening, to name a few. Not to mention any number of emergency facilities that could be conjured up and deployed within the Treasury in troubled times. This wasn't always the case. When inflation was skyrocketing just 4 decades ago, Paul Volcker was elected Fed chairman in 1979 with a mandate to crush high prices. The consumer price index reached a high of 14.8% in 1980 before his inflation-fighting efforts took effect. Prior to Volcker, the Fed targeted short-term interest rates to manipulate the money supply to juice or put the brakes on the economy. Without wading too far into the weeds, the Volcker-era Fed targeted the actual money supply. This and other changes persisted mostly into the end of the 80s, even after Alan Greenspan became chair in 1987. But Greenspan pivoted and developed his own style in the 1990s, returning to interest rate targeting and instituting insurance cuts to get ahead of various crises, including the 1998 bailout of hedge fund long-term capital management, orchestrated by the Federal Reserve Bank of New York. In fact, the Fed has raised rates a year before the beleaguered LTCM became a systemic risk. This made the 1997 single rate hike the shortest rate hike cycle, if you can even call it a cycle in the modern era. Its short duration is probably why the 38.5% stock market rally over the following years was by far the best among 4 other tightening cycles. The other post-rate hike periods averaged gains of 5.9% with the following year with the year following the 1994 increase barely eking out a 0.1% return. So you can see here on this chart, the 1997 hike versus all the others, which were far more muted in their returns. The bias towards easing earned Greenspan the nickname Easy Al. After Greenspan popped the late 90s tech bubble, he would eventually lower rates to 1% in 2003 and keep them there for a year. All this set the stage for the Fed to help fuel a housing bubble, this time with a huge run-up in commodity prices. WTI oil rallied relentlessly, topping out at $150 a barrel. Sound familiar? But Bernanke picked up where Greenspan left off, leading the Fed to raise rates 0.25%, 17 times at consecutive Fed meetings. In late 2007, as central banks around the world worked to reduce the leverage in the bloated financial sector, cracks in the financial system turned into gaping holes. Bear Stearns nearly folded in March of 2008 and was sold to JP Morgan for a song. At the time, many thought the worst was over. In the spring and summer of 2008, the Fed began winding down its balance sheet from all the emergency lending programs it instituted, selling and letting roll off $300 billion in treasury bills. Markets even started pricing in about 140 basis points worth of rate hikes into the end of 2008. The failure of Lehman Brothers in September of 2008 put those hawkish notions to rest. Perhaps an important lesson to remember as the Fed is now forecasting 6 more rate hikes. Powell even said Wednesday at the presser that balance sheet runoff could come as early as the next Fed meeting in May. Quote, do we see balance sheet roll-off? End quote. Quote, do we see balance sheet roll-off? And how aggressive is the Fed going to be with this? We were used to the central banks coming in and suppressing volatility, but that's not going to be the case for the foreseeable future, end quote, said John McClain, portfolio manager at Brandywine Global, expressing concern that the Fed may not be paying attention to the recent volatility in stocks and bonds. Quote, we need to buckle up and understand that enhanced volatility in risk assets and interest rates are going to be here as we're unwinding unprecedented monetary stimulus amid a number of exogenous factors like ongoing war and rampant inflation. So it looks like we might be repeating the same act that we went through not too long ago. So, personally, I would have liked to have seen, interest rates, maybe 0.5%, 1% this time, crank it up, a percentage point every few months until prices start, pulling back. Also, you might want to reduce the money supply. I mean, we've created, last I checked, about 39% of new dollars have been created in the last 2 years. I know some people will say 80%, but they're going off the M1 number. I prefer to use the M2 number because it puts all those dollars together, and there wasn't a change in how it was calculated like they did 2 years ago. So anyways, all right. Last article here, gold at $10,000. Whew. That would be outrageous. That'd be a 5 times multiple from where we're at today. Death of the 40-year bull market in bonds. What's next for the global financial system after Russia's central bank gets canceled? It was written by Stephen Goldstein. All right. Shockwaves are still being felt by the incredible Western sanctions that have been rendered the $630 billion in reserves the Russian central bank accumulated virtually unusable. Can the current dollar-centered global financial system last if money can be summarily canceled? Arthur Hayes, a former emerging markets trader and co-founder of BitMEX trading platform, argues central banks will choose instead of dollars to load up on either gold, storable grains like wheat, or storable commodities like oil and copper. End quote. In essence, the largest surplus countries' fiat currencies will implicitly grow their gold or commodity backing, he writes, saying gold continue to rise beyond $10,000 per ounce. Luke Groman, publisher of Forest for the Trees and longtime dollar bear, said that shift has been happening even before the sanctions. In a podcast with Grant Williams, Groman said that over the last 8 years, global central banks have bought about 260 billion worth of gold compared to 60 billion in treasuries. So there's been this very slow but steady and recently accelerating move toward the away from this dollar system that broke in 2005 through 2008 to this system that looks a lot like what was proposed by John Maynard Keynes 80 years ago, end quote, he says. The dollar-centered system has some disadvantages for the U.S. Quote, the issue with this American version of this deal is that we're printing dollars for oil and have been since 1973. And the downside of this deal is that you run deficits to supply the dollars to the world, he said, which means you go offshore, which means you got to go offshore you got to offshore all the manufacturing. You got to offshore all the manufacturing jobs. You got to run a bunch of deficits at the government level. You got to do all this, or you got to do all these things that are really, really good for GDP growth and the economy in the short term and medium term. And in the long run, they bankrupt you. Groman, like Hayes, expects more gold accumulation. Quote, so every central bank in the world is now looking at this and thinking, okay, we need not to be in a position where that can happen to us, because who knows what might happen in the future and what might U.S. deem, or what might get us deemed as a bad actor. So presumably they are going to be looking to accumulate a lot more gold. Groman expects the end of the 40-year bull market in bonds, and he sees the potential for reindustrialization. Quote, when you see Ohio getting the Intel fab and the CEO of Intel saying, quote, we're going to make Ohio one of the biggest Intel manufacturing regions in the world, end quote. What? Ohio, the ground zero of the people who took it in the shorts from 1973 to the present under this deal, under another semi-fab in Arizona, another semi-fab in Texas, says Groman. It's not even the first inning of this reindustrialization of America, but reindustrialization was never going to happen until you changed the dollar system and removed treasuries as the primary reserve asset. Replaced it with a neutral one, and here we are. We're 2 weeks into it. It's incredibly exciting, end quote. So it looks like gold, I'm a big fan of sound money, and backing your currencies with gold, to me would be probably one of the wisest things to do. Our fiat dollar today is, worth nothing more than a piece of paper. It's not even worth the paper it's printed on. Gold and silver, those are money. Oil, it's a commodity, can be used as money. Chickens can be used as money. You can swap them for something else. But currencies are nothing but are supposed to be a store of value that should hopefully retain its value over the long term, which unfortunately over the last 30 or 40 years, the US dollar has not done a very good job of doing that, primarily because we continue to inflate it at a very significant pace. So, all right, well, that's everything I had for today. I hope everyone enjoyed my video. If you didn't, I will try to do better tomorrow. I'll be back tomorrow with the weekly wrap up for this week with all the important news and economic data that's come out this week. So if you need anything from me, don't hesitate to reach out. I'm at dsafinancialgroup.com. All my contact information is there. Or you can reach me at my email address right here on the screen. So like I said, I'll be back tomorrow. Hope everyone has a great night, and I'll see you then. Enjoy some college basketball, folks. Bye-bye.